What if your mortgage, the thing you've been told is your biggest asset, has a bigger cost than you think? What if the standard 30-year loan has financial trade-offs that are designed to be, let's say, less than obvious? Banks rely on some basic math that's completely out in the open, but they're banking on you not looking too closely. Today, we're not just going to look, we're going to break it all down. And then I'll show you how to make the system work for you, not just for them. From day one, we're told the script is simple. Get a good job, save up, and buy a house. It's the foundation of the modern dream, pitched as the most important investment you'll ever make. You sign a mountain of paperwork for a 30-year loan, you get the keys, and boom, you've made it. You have a fixed monthly payment, you know exactly what you owe. It feels stable. But what if that stability comes with a hidden price? The system is built to give you a sense of security, but the real costs aren't always printed in black and white. So how does the bank really win? It's more than just the interest rate you see on paper. They earn on the interest spread. That's the difference between the rate they give you and what it costs them to borrow. They charge origination and servicing fees just to set up and manage your loan. And often they sell your loan to free up their own cash to make new loans or manage their risk. But their most powerful tool is something called amortization. If you've ever looked at an amortization schedule, you'll see that in the first several years of a 30-year loan, the vast majority of your payment goes straight to interest. You're building a little equity, sure, but you're barely making a dent in the principal, the actual loan amount. For years, a huge chunk of your monthly payment is just the cost of borrowing the money, while your real ownership stake grows at a snail's pace. But even that isn't the true hidden cost. The real, mind-blowing cost is something economists call opportunity cost. Opportunity cost is simply the potential gain you miss out on when you choose one financial option over another. Think about it. That huge down payment is a massive chunk of cash. Every dollar you pay toward your principal is now locked up in your house. It's not in the stock market, it's not compounding for you. And while your home equity can grow if property values go up, the cash itself is illiquid. You can't spend it easily. So what could that money be doing instead? What if you had invested that down payment and maybe the difference between a mortgage payment and rent into a simple S&P 500 index fund? Historically, over long periods in the US, the stock market has generated higher returns than the average national home appreciation. Now, this is not a universal rule, and it depends heavily on the time period and location, but the general trend holds true. That difference, the one between what your money could have earned in the market versus the equity you're slowly building, that is the true hidden cost. Depending on the numbers, that gap could represent hundreds of thousands of dollars over 30 years. So, what's the play here? This isn't an argument for never buying a home. It's about understanding the game so you can play it smarter. The key is to weigh the return you get from paying down your mortgage against the potential return of investing that same money elsewhere. Here's a popular rule of thumb. Paying extra on your mortgage is like getting a guaranteed risk-free return that's equal to your interest rate. If your mortgage rate is high, say over 7%, aggressively paying it down can be a fantastic risk-free financial move. But if you have a lower rate, say under 5%, the math often suggests that investing your extra money could be the better long-term play. The average historical return of the stock market has often been higher than a low mortgage rate, and that gap is your opportunity. For rates somewhere in the middle, a hybrid approach might work best, paying a little extra on the mortgage while also investing. But remember, this is just a guideline. Your personal risk tolerance, financial goals, and timeline are what truly matter. The financial world is full of conventional wisdom that often benefits other people more than it benefits you. If you're ready to keep pulling back the curtain and learn how to make your money truly work for you, make sure you subscribe and hit that notification bell. The goal isn't just to be debt-free. The goal is to build wealth, and wealth comes from having your money actively working for you. A mortgage isn't inherently good or bad. It's a financial tool, but it can be a trap if you don't understand the math behind it. So don't just blindly follow the 30-year plan. Think about your opportunity cost. Compare your mortgage rate to what you might earn by investing. By understanding the real cost of tying up your money in a house, you can finally make an informed decision and choose the path that builds your wealth, not just the bank's.